Welcome back to the What's Your More episode. Here we are dialed in for part 2 of the lending update, our rate conversation that we take on. And I'm going to start with asking our audience, like, hey, what does the rate need to be for you on your mortgage that you currently own or that one you're looking to obtain in order to make that move? Like if you're looking to refinance, if you're looking to buy or sell, what does that rate need to be? Currently, we're in the 7s. Like, do you have a numbers at 6.5? Are you comfortable at 6.25? I mean, given, I know everyone wants if the answer is going to be the lowest rate, I get that already. All right, that's a redundant point. But like the specific numbers at 5.5, 5.75, we'd love to hear from you on that because we have what we think it is, but we would love to hear back from you guys. So if you could leave a comment on our YouTube channel. But as you're kind of learning about rates and you're learning about, okay, mortgage shopping and what to go, we're going to kick this episode off with a free gift from our co-host who is joining us today, Mr. Daniel Halverson. Welcome to the show again.
It's good to be here again.
Yeah, it's like you never left.
That's it.
There it is. I beat you to it. Anyhow, so the reality is this. Dan's got a great tool. We closed out last episode with it. We're going to kick off this episode with it. So when you start searching for rates, there's techniques you can do to get, quote unquote, the best rate. They're quite simple, but if you don't know them, no one's going to tell them to you. So it doesn't matter if you're working with Daniel and his team. Obviously, we'd love for you to. But if you're working with someone else, these tools work there as well. So Dan, you want to talk to him about how to get the best rate?
Yeah, I sure do. So we created a guide around all of the variables that influence the interest rate that you get. And for a lot of consumers, what happens is they go apply for a loan, and then they just apply with multiple other companies to see who's got the lowest rate based on their qualifications. What a lot of people don't do is go look and say, okay, how do I improve my qualifications so that my rate starting out with all these different lenders is at a lower number?
Right.
So that was the point of this guide, is how do I make sure that my qualifications will maximize my ability to get a low interest rate on my mortgage. So that way, if you're shopping interest rates, like I said, you're starting at a lower point because you have improved your ability to qualify for a better rate. So go through property types, property use, loan to value ratio, loan terms, how points work into that. There's a number of different things, working on some bonus content as well to really kind of drive some further points home. But you can go to howtogetthebestrate.com, download it for free, do whatever you want with it. Obviously, we'd love to talk to you, but this is something that holds true whether you get a mortgage from Bank of England or literally any mortgage company anywhere.
Yeah, and so I love it. It's a universal tool. And if you're a real estate agent, like this is a great gift for your customer too, because now you can help them with that. You don't have to worry about playing the field. It's right there in front of you. And guys, this is coming from someone, Daniel's not just like someone that's been in the business for a long time, like extremely successful. I mean, the #1 lender in all of Northeast Florida for how many years in a row?
4.
4 years in a row. Like out of everybody in 4 surrounding counties, this guy owned it. So, and then what he's done is he surrounded himself with people inside of the company at Bank of England. They're all crushing it right now, and they're all dominating, and they have a great tool here. Take advantage of this is what I'm trying to say. So please, free gift from you to be on our YouTube channel at What's Your One More, and you're hearing it from not only a pro, but what I would deem as an expert in this field. So thanks for doing that, Daniel.
Absolutely.
So, hey, we know that you guys tuned in because you didn't want to hear that. You're ready to hear the rate conversation. So here we go. Let's kick it off as we do every episode of part 2 of the lending update. So I think we've come to this conclusion now. Target rate 2%. Now, let me preface with Daniel and I said this in the last episode. We had the opportunity to sit down in a fireside chat, probably about 60 people, 10 of them being staff members of the Federal Reserve Atlanta, Federal Reserve Chairman Raphael Bostic. But hey, he was pretty witty, had some good humor too. I was kind of surprised by the tone of the conversation. But as we kind of bring that conversation to light, one of the things he went back to was we need to see the labor market get potentially worse. There needs to be some cracks in the labor market for us to start thinking of a rate cut. And I think this is kind of bringing to your point that you have eloquently nailed home here for the last really 6 episodes of this. Hey, listen, we're going to have to see the labor market break. It's just all there is to it. Labor market's going to have to break because everything else is already there, but they're not moving yet. So there needs to be some weakness. Are we starting to see signs?
I would say so. Yeah. I mean, the problem is we get data one month that says one thing, and then the next month says something different. But, April was a month to forget from mortgage rates. Pretty much across all spectrums. Job data wasn't helpful. CPI, inflation data wasn't helpful. Retail sales weren't helpful. Nothing really worked in our favor. Yeah. But the May data that we got, which was for April, showed an uptick back in the unemployment rate to 3.9%, which is its highest since January of 2022.
Yep.
And average weekly hours ticked down. Basically 1/10 of an hour, which doesn't sound like much, but if you extrapolate that across 160 plus million working people, it's a big number in terms of people earning less money.
I was going to say lost wages. Yep.
And basically, average hourly earnings rose less than expected. So we're now inside of 4% annual wage growth, which is something that the feds are keeping an eye on. And unfortunately, they want to see you make more money, just not too much more money.
Mm-hmm.
So that number continues to come down, albeit it's still a strong number, right? 3.9% wage growth is still a strong number. But what I thought was interesting is that a lot of the sectors that have been responsible for the majority of the job gains, they weren't the reason that the job gains improved.
Correct.
So leisure and hospitality has been an industry that obviously very much impacted by COVID, had this big catch up of jobs that had to be refilled as the economy opened back up.
Mm-hmm.
And in Florida, that may sound crazy to us because we were closed for like 15 minutes, but there were states that were had a much longer period of time dealing with that. So leisure and hospitality has been a big source of job creation, so have government jobs, neither of which showed much, if any, job growth.
Mm-hmm.
And really the quote unquote job growth was all due to modeling of small businesses and saying small businesses created this exorbitant number of jobs, which they have absolutely no way to know that. It's all assumption-based metrics that they're using. So
Right.
The household survey, which is what it sounds like, actually talking to people, continues to suggest that the job growth is really not nearly as strong as the business survey. But and once again, prefaced by saying we don't want people to lose their jobs. In fact, we want them to have jobs so we can do mortgages for them. So
Correct.
But if you're looking at when will rates come down, well, the feds want to see the labor market slow down, right? They don't want it to collapse, but they do want it to slow down. So all of these things work in the favor of mortgage rates, which is really what accelerated interest rates coming down by over 0.5% over the course of the last, 2.5, almost 3 weeks as we record this.
Which speaks to our point we've talked about. The Fed doesn't have to cut rates for mortgage rates to come down. For the rate environment to improve, they don't have to cut. They just have to say the right stuff.
I would agree with that to an extent. I think there's still a ceiling on, or a floor on how low interest rates will go until rates begin to cut. But yes, I mean, you could see interest rates come down, mortgage rates come down further than they are right now without a rate cut.
Yeah, there is a floor until there needs to be a rate cut, right?
Sure.
Right. All we're doing right now is evaporating that disparity between the 10-year and the 30-year fix, right?
Correct.
All that uncertainty is starting to be evaporated.
But you also look at the week following the job report, initial jobless claims came in about 10% higher than they had been, which was a 9-month high. So it's another data point where, okay, well, if jobless claims start to creep up, that's really the leading indicator of weakness in the labor market. Sure. And the feds, they look at a lot of things that we can't even fathom, I'm sure. But that's something that that's something they monitor very, very closely is initial jobless claims. And that's the one number that if that continues to climb and get to certain levels, that rate cuts will be a focal point of conversation, regardless of what inflation is doing, because you can't let the labor market collapse in this fight to go from 2.8% inflation to 2% inflation, right? So that's really we've said this before, that the labor market is the quickest path to rate cuts. Mm-hmm. And Bostic, I thought it was interesting, probably the most interesting thing that he said for me when he was asked about basically getting inflation to 2%. Do they think that's feasible, or are they going to move the goalpost essentially and say, well, we're going to get it to 2.5 and feel like we've done our job? But he vehemently, very confidently answered and said, we're getting to 2% inflation.
100%. He was adamant.
He was very adamant in that. And the guy's obviously very intelligent. He's equally as intelligent on answering questions without answering questions.
He did a very good job of that. Very impressive.
Not a rude thing, just to very eloquently answered a lot of things without providing a real answer, which he can't on some of these things, obviously. But that was one thing that he very, very precisely answered. And my takeaway from that is, well, it will be really interesting to see how he feels about that if the job data continues to get worse and the inflation numbers aren't quite where they want them. Just they'll be in a conundrum that I would not want to be a voting member for.
Correct. And he did make a comment towards the end. He said, we are optimistically but cautiously watching the job market. And he goes, as I sit here today and I tell you, that he thought there would only be one rate cut remaining in the year. Just one. There's only going to be one. That's all I got. But he said that could change if this job market decides to pivot. Then we're going to have to move with it to prevent, they don't want a recession, right? So he didn't like the word landing at all, so they quit using that. But he doesn't want a recession, and so that was the thing. Now the good news is there's more than just him voting, and he naturally has a hawkish pretense to his demeanor, anyways, right? So he's not the guy that's like, hey, we need to cut. But we do know this: when the Fed members were surveyed, we know that 3.9 number on that unemployment handle, that's a scary number for them. So if that thing goes up, and the range was 3.9 to 4.1, so we're within range.
It's at the low end of their I'm alarmed, you have my attention range.
You have my attention range. Matter of fact, of the 19, 11 of them said you got my attention, which is the majority, right? So that could be a potential issue. But as we get into some of the indexes, right, we just got CPI, PCEs next week, right? By the time this drops, PCE will actually be either right out there or coming up next. But with the CPI, we got some relief. You want to talk a little bit about that, but also talk about what Bostic said in regards to CPI, because I thought that was interesting. We had never heard that before.
Yeah, absolutely. So the other thing that helped us here is we got job data. Then the next week we got inflation data. Still not at 2%, but year-over-year inflation came down to 3.4%. That's after 2 or 3 months of inflation on the headline going up a little bit. And then the core rate came down to 3.6%. Once again, not 2%, obviously, but it's the lowest reading on the core in 3 years. So that was obviously that last reading we got was on the way up, right? At the base of the mountain. But that's big news because the core rate is more within what the Feds feel they can control with monetary policy. And it was interesting, though. Bostic essentially said 2% is what they want to see on the personal consumption expenditures, but 2.5% inflation is their target on CPI.
Yeah, he said it kind of equates to 2.5%. I
Correct.
had never heard that before. And all the stuff that we've studied and talked to economists, never seen that type of correlation. Yeah,
and I did a little bit of very, very quick research, nothing expert by any means, but it doesn't appear that the CPI is really ever within 0.5% of the PCE reading.
Not.
So I'll be interested to see if they can even accomplish 2% inflation on PCE and 2.5% on CPI.
Yeah, it's not close at all like that. I mean, they're not relative to one another within 0.5 point.
Yeah, not to lose people here, but context. It doesn't sound like what they're looking for is easily accomplished.
Yeah, it sounded like that was a curvy through the audience there. It's like, I'm going to see if they're listening. I'm going to throw this out there. And if I remember you and I both look at each other like, that doesn't make any sense. But what's interesting about this, talk a little bit about this. For our audience, guys, we've been talking about CPI and PCE, and I know you guys are acronymed to death, but by now, many of you haven't. For those that don't, just a quick explanation. The Consumer Price Index, that's what the consumer feels on the street. That's like what they're seeing. The PCE is what the Federal Reserve is measuring inflation in, and there's different weighted averages of the components in there, and that's what really differentiates them. And there's a few little extra things in the PCE that are not in the CPI, but the CPI seems to be a market mover more so than the PCE, and that's where I'm going with this. Is the CPI good news? Wall Street roars. We're over 40,000 on the Dow. That's not ironic. There's much more confidence now on the market. You've got the S&P over 5,300. The Nasdaq's hitting all-time highs. The CPI plays a big role in that when that comes out because that has the markets roaring, right? It also helps the mortgage market, ironically. But the PCE is going to be what the Federal Reserve stands on to make, I guess, their decisions or make their informative information based on inflation. So it's interesting to me how those two things, A, don't correlate in the manner in which he said, and B, move the market completely differently.
Not to get off topic, but I think this is interesting. So when interest rates were on their way up, the Feds were hiking interest rates. It was kind of this interesting conundrum where the Feds would hike interest rates and mortgage interest rates would get better, which is kind of the inverse of what you think should be happening. But
Correct.
Essentially that was happening because the markets were saying, yay, the Fed's going to stop inflation, right? And now we get really bad job data where the job market's way weaker than expected and the stock market roars, right?
Correct. Yeah, this is great.
These companies are going to miss earnings and all these things are going to happen, but you know what? Maybe we'll get a rate cut.
Heck yeah.
So it's to a point, right? To a point that will happen at some point if the labor market continues to get worse. Well, that will do the inverse. But in the short term, bad economic data in some cases is actually propelling the stock market.
Oh, 100%. And Charlie, I'm going to send this chart over to you to put in here. I don't know. I'm not 100% accurate, but I want to throw this in here. When we were this is crazy to me, when we were at a high CPI, was it like 6.5 on the core? and then the PCE of 5.6, like that's the core, right? Not the headline. We had lower interest rates than when we're at 3.6 and 2.8 right now. We had lower interest rates. It shouldn't be like that. Like that's just, to our audience, that's why you hear us so adamant. Like this is going to not break, but this is going to come down, because this doesn't make any sense. The real interest rates are much higher than they should be right now, and that's going to make its way back down just based on data. So it'd be like this.
Well, you also have, if you're the feds, you have this other dilemma, which they're not entirely responsible for, but the government continues to spend more and issue more debt, and their interest expense is becoming considerably higher. I saw something that said 100 trillion every, or a trillion, sorry, every 100 days, that this higher interest rates are adding to the debt. So they've kind of got this dilemma here of nothing's really working in their favor, right? Inflation's not moving down as quickly as they want. Labor market's not slowing as fast as they want, and higher interest is not doing good things to the national debt. So they're in this conundrum where at some point the rubber's going to meet the road on one of those things, and they're going to have to cut rates, and something probably out of those variables will not support them cutting rates, but they'll have to make a decision. But on the economic data stuff, the last thing that I'll say that I think is kind of being overlooked here is when the Feds met at the end of April, they did not cut rates. We knew that was going to be the case, but they did announce that they were going to slow their balance sheet reduction, and explain this briefly in the lending update. But essentially what that means is the Federal Reserve bought a bunch of government-issued debt and mortgage-backed securities.
Right.
When COVID started, quantitative easing, right? And they own all of these, and they all have different maturities, the government debt side especially, all different maturities based on how long the bonds or the T-bills were issued. And essentially what they've been doing up until this point is when those bonds mature, they are just letting them go, and they come off the balance sheet. But now the feds are saying we're going to spend a certain amount of money, of billions of dollars, to essentially take the principal I get on the bond when it matures and then go buy more. And that may not mean a whole lot, but it is going to provide some stability to what happens with Treasury yields. And the 10-year Treasury is very much correlated with mortgage rates, inversely, right? So if there's more stability in the bond market, the Fed's now become a buyer of government debt. Well, that in itself could lead to a lot more stability. I think it really probably would just stabilize mortgage rates more than it would propel them considerably lower. But that's something I don't think is getting talked about enough in terms of the last Fed meeting, is the fact that they're now doing that. And the Treasury, the U.S. Department of Treasury, is actually doing some of that a little bit as well. Yep. So now you've got buyers of government issued debt that were not there before, which was also causing the yields to go up so high that basically nobody wanted to buy mortgage bonds, because Treasury yields got so high that why wouldn't you? Right. You'd rather have 0% default risk than whatever the default risk is on a mortgage-backed security. Sure. Presumably it's higher than zero. Maybe somebody that knows that can chime in the comments. But that's something that's not really being talked about as much either, that I think just stability, right? If you're shopping for a home and the rate's 7, hopefully it's going to be pretty close to 7, higher, a little higher or lower within a 30-day window, and it won't have jumped to 7.5.
Yeah, there's a lot to unpack in what you just said there, and I kind of want to back up here. So, you look at, with the way the rates are right now, the way the Federal Open Market Committee has set the Fed funds rate, that pressure on the national debt has become now that interest payment. And that interest payment is the second highest expense in the United States budget right now. Let that sit in for a minute. It's rivaling the Department of Defense budget. Like it's almost more than that now. If we stay on this track, it is anticipated by the end of the year it'll be the number one thing in the budget, the number one most expensive thing in the budget. That shouldn't happen. That's pretty uncalled for, and that's kind of what you were absolutely what you were speaking to there. And then that last part that you mentioned, that the Fed coming back with the U.S. Treasury Department to be the main buyer of the 10-year notes, right? So they're the number one buyer. We lost them. They've been gone for quite some time. They've been gone for over a year. So think about this. Like, if your number one buyer of your product is gone, are you going to suffer as a company? Well, hell yeah, you're going to suffer as a company. So what are you going to do? You're going to try to improve the price to get more number one buyers. So what's happened with the 10-year? As you said, it's inversely proportional. So the ideology of what would be the same on the bond side of lowering the rate would be raising the yield, right? That's lowering the price point would be raising the yield, because you're attracting more buyers because it's more attractive, right? So that's why it's been steadily rising. There's been no buyers. Oh, and by the way, All the foreign participation, gone. Our number 3 and 4 buyers, Japan and China, gone. Well, now they're back. So we're having our top 3 of our 4 buyers are returning. That's going to make that product more attractive, which we should see the price come down. The yield should come down, which I think is that stability you're referring to. Is it going to be a 7 to 5.5? Hell no. But 7 to 6.75 over the course of a 30-day window, that's not hard to believe could happen. And that's a lot of that stability you're referring to is making its way back into the market.
Absolutely, yeah. I think that's one of the biggest things that have been lacking here, right? Amongst everything else has just been this wild volatility in the rate market that has spooked some buyers. But, so far as we move into May here, mortgage applications have been up predominantly most weeks with lower interest rates, and we're moving into peak home buying season. So it's certainly welcome news if you are a mortgage loan officer or in the real estate profession to see rates coming down at a time where typically people transact more.
Yeah, and I think you said it's getting way overlooked. And to kind of sum this up, guys, here, if I'm a real estate agent, if I'm a mortgage lender, this is a good thing. If I'm a buyer, this is really good. Now, you may not be tuned into the day-to-day and balance sheet run off this and maturity coupons. I don't get all that. All I know is that the Federal Reserve has returned to the market to purchase 10-year notes. That's big because and mortgage-backed securities, 10-year notes. They have not announced that they're going to be buying mortgage-backed securities yet. And I think that that's something we're going to be waiting on because it still applies a little pressure. And if they had come out and said, hey, listen, we're going to use a portion of this to buy treasuries and buy mortgage-backed securities, we have sent a bigger relief. But not yet. It's coming. It looks like all signs are pointing towards that. So we'll see what this next meeting holds. I will say this. Future forecast. Here we go. Dan, if the PCE comes in below expectation, is that enough for the Federal Reserve to, A, cut rates? We'll start with that.
I would lean no.
Okay, no. Is it enough for them to say, we're going to go from tapering 60 million, because they were doing 90, now they're at 60. That's that maturity coupon runoff you described. That's that tightening from 60 to 45 to lower that 60 down and put another 15 million a month back into the system. Potentially, right?
Potentially.
So if I hear you correctly, you're saying that if PCE comes in less, we had a CPI less. Oh, and by the way, let me throw a kicker in there. Labor market, we start seeing another bad labor market report. So bad labor market report and favorable PCE, is that enough to lower rates?
You could start to really state your case. I think the markets would start really jacking those probabilities up for the near future for mortgage rates. I think the biggest thing with the Feds right now is just the inconsistency of data, and things don't happen in a straight line, right? Mm-hmm. It's not like every single week initial jobless claims will be higher than the previous. At least you hope not. But I think that there's just been very little consistency where you've had the year has started really with inflation just on the uptick.
Right.
And the job market has been more good than bad.
Right. It's been very resilient.
Whereas towards the end of the year, you started to see more bad job prints and, better inflation. But I think if you started to stack 2 or 3 months, I think that at that point you could very much clear the path for a rate cut.
I agree. And I think you're right on with that, because I think you heard Bostic say one reading isn't a trend.
Correct.
That was the sentiment there, that he made sure everyone know one reading is not a trend. It's a one-off. I need to see a trend, meaning 3 in a row is what he's suggesting. So by the time the Fed meets, we're only going to have a PC and a labor market reading inside there. Plus we already had the CPI. So if he kind of carries the tonality as the rest of the Fed, then he's already telling you there's not going to be one. However, there's more than just him. If that unemployment rate creeps over 4.1, that might be enough for them to pause and say, we might have an issue here.
I think that's the money ball.
There's your money ball.
That's your fastest and clearest path.
Okay, so if you're tuning in every Thursday, watch the initial job loss claims report. It gets above 250, you're going to have a little headwind. If that unemployment's over 4.1, Dan and I are both saying cut the rates. I'm saying cut the rates regardless.
8:30 Eastern Standard Time every Thursday.
Every Thursday. All right, guys. Hey, if you like what you're hearing, please tune in to this podcast, share it, 5-star review it. More importantly, leave some comments. Check us out on our YouTube channel at What's Your One More. We love the comments and the feedback you guys are putting on there, and appreciate you tuning in this episode. More importantly, Dan, thanks for being here today and giving us all that insight. Appreciate all the hard work you put in these lending updates.
Until next time.
Yep, absolutely. We got to see you at the next episode at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.